Understanding pro rata, definition, calculation, and applications. Pro rata, a term derived from Latin meaning, in proportion, is a fundamental concept in finance, business, and various other sectors. It refers to the method of allocating a value proportionally based on the ownership or involvement of individuals or entities in the entirety of a situation. This article explores the concept of pro rata, describes how to calculate it, and provides practical examples across different fields. Key takeaways. Equal shares. Pro rata typically ensures that everyone receives a fair share of allocations according to their applicable proportion. Business application. It's widely used in finance for dividend distribution, billing, and income allocation in partnerships. Root and fractions. Pro rata calculations are rooted in mathematical fractions, making it comparable and universally applicable in financial contexts. How pro rata works. In essence, pro rata means that any given amount or benefit is divided among the recipients based on their respective ownership or involvement. For instance, if dividends are declared, all shareholders will receive a distribution based on how much they invested in the company compared to the total amount of shares available. Example calculation. If a corporation has issued 1,000 shares and decides to distribute $1,000 in dividends. Share 1, 500 shares, $500/$1,000, $1,000 equals $500 dividend. Share 2, 300 shares, $300/$1,000, $1,000 equals $300 dividend. Share 3, 200 shares, $200/$1,000, $1,000 equals $200 dividend. The calculations above ensure fairness based on ownership. How to calculate pro rata. Calculating pro rata involves three main components. 1. Number of true items, the count of what one possesses or has been incurred, days worked, shares owned, etc. 2. Maximum quantity possible, the total quantity available, total days, total shares, etc. 3. Quantity of related item, the total amount of the asset to be divided, bonuses, dividends, insurance premiums, etc. Formula. Pro rata share equals number of true items / maximum quantity possible. Pro rata distribution equals pro rata share quantity of related item. Example, bonus calculation. Imagine an employee is eligible for a $10,000 bonus and works for only part of the year. Days worked, 79 days. Total days in the year, 365. Pro rata share equals 79/365 equals 21.64%. Pro rata distribution equals 21.64%, $10,000 equals $2,164. Thus, the employee's fair share of the bonus, based on the days worked, is $2,164. Common applications of pro rata. Pro rata has diverse applications across different sectors, including 1. Dividends. In the realm of corporate finance, pro rata is essential when distributing dividends to shareholders in accordance with their holdings. 2. Insurance premiums. Insurance companies often need to prorate premiums when a policy only covers a part of the year. For example, if an auto policy costs $1,000 per year but is only needed for 270 days, the calculations would be \text pro rata premium equals \left \frac 1,365 \right times 270 equals $739.73. 3. Interest rate allocations. Pro rata calculations can also help determine the interest accrued on an investment over a specific time frame. If an investment yields 10% annually, the pro rata interest for a 2-month period would be calculated as \left \frac 10 %, 12 \right times 2 equals 1.67 %. 4. Accrued interest on bonds. When bonds are sold before their next coupon payment, accrued interest is calculated on a pro rata basis. The formula for accrued interest is AI equals text, face value of bond, times text, coupon rate, times text, time factor. This demonstrates the applicability of pro rata in both individual and corporate financial scenarios. Pro rata versus prorated. While pro rata and prorated are often used interchangeably, subtle distinctions exist. Pro rata refers generally to the concept of proportionate allocation. Prorated typically refers to the action or result of applying the pro rata principle in specific cases, often in billing or expense allocations. The bottom line. In summary, the pro rata principle serves as a fair and impartial method for distribution based on ownership or involvement. It plays a crucial role across various financial operations including dividends, billing, interest calculations, and insurance premiums. Its foundation in basic mathematical principles ensures clarity and precision, essential for maintaining fairness in financial dealings. Understanding and applying the concept of pro rata can empower individuals and businesses alike to make informed financial decisions.